Okay, so continuing on with Chapter 1, here we're going to discuss in additional issues what happens when there's a change in the equity method, what happens when the investee has other comprehensive income, what happens if the investee has losses, and talk about sale of equity method investments. Okay, so what happens when you have a change in the amount of ownership that you have? Well, let's talk about first if you have a change from fair value method to equity method. What's happening? Starts out owning 10% of a company, then sometime later, a couple of years later, purchases an additional 30% so that they now have the ability to have significant influence over the investee company. And so what happens when you move from fair value to the equity method is that you have to restate the financials for all those years retroactively so that the investors' financial statements appear as if the equity method had been used all along for all those years from the date of the first acquisition. So you can imagine what results from the time of the initial acquisition. So, but that's what FASB requires, so you must do that. And so one thing the rest of this slide doesn't give you is some of the examples in the book. So if you look on page 14, you've got this company, giant company, who invests in 10% of small company in 2014. And so during 2014, small company has net income of $70,000, cash dividends of $20,000, $110,000 income, dividends of $40,000, and at January 1, 2016, $130,000 net income, cash dividends $50,000. And then you've got your fair value as of January 1, 14, 15, and 16. Notice that as of January 1, 2016, there is an increase of $130,000 in the fair value of this investment. Okay, so originally Giant would have reported net income, well, they would have reported a total of $130,000 of, well, $13,000, since this is total amount, fair value. So their adjustment would have been $13,000 in the fair value. During that time, they would have, if they were under the equity method, received or recognized equity and investee income of $7,000, so 10% of the $70,000. They would have reported $2,000 of the $20,000 dividend in 14, and of course in 15 they would have shown 11,000 their portion of net income and 4,000 reduction from dividends. So the net effect of all that is 5,000 for 2014 and 7,000 for 2015. So the adjustment that they have to make is there on page 15. They make a debit to investment in small company, so that increases their investment in small company by 12,000. And then the credit is to the retained earnings prior period adjustment equity in investee income. Now, the second part of this is dealing with this unrealized holding gain of $13,000, because the fair value went from 10% of 800,000 to 10% of 930,000. And so they're going to debit unrealized holding gain, shareholders' equity of 13,000. That removes the valuation accounts that pertain to the investment prior to obtaining significant influence. And the credit is going to be the fair value adjustment available for sale that would have been made prior. So as it says, to remove the investor's percentage of the increase in fair value from shareholders' equity and the available for sale portfolio valuation account, because it's no longer an available for sale account. They also, if you look at near the bottom of page 15, they have these other adjusting entries that they make, but these relate to the operations and distributions for 2016. And so they take their portion of the $130,000 net income for 16. So that's 52,000 debit investment in small company and credit equity in investee income. And then of course you have to deal with the receivable by noting a dividend receivable, reducing your investment in small company, that's your credit. And then when you actually receive the cash dividend, you debit cash and close out the dividend receivable by crediting it. So that's how that works. All right, moving on to other comprehensive income. Not all income that in net income. And so when an investee company has other comprehensive income, that has to be reflected by the investor company. And so they have an example here in the book where Charles Company applies the equity method, accounting for its 30% investment in the voting stock of Norris County. No excess amortization resulted from this investment. Norris reports 2014 net income of $500,000. They also report $80,000 in OCI from pension and other post-retirement adjustments. And so Charles' company would accrue earnings of $150,000, which is 30% of $500,000 net income. On top of that, they've got to report their percentage of the 80,000 OCI. So they're going to report 30% of the 80,000 OCI. And so if you look at page 16, they're increasing their investment in Norris Company by 174,000 debit. 150 of that credit goes to equity and investee income, and then another 24,000, which is the 80,000 OCI, total OCI, multiplied by 30% that Charles owns. So other comprehensive income, 24,000. So that's pretty cut and dry. Let's see. And so this just to indicate that you might have other sources of income. Anytime that occurs, the investor must report its share of these types of items that might include discontinued operations, extraordinary items, and then, of course, OCI. Well, just like if an investee company has net income, has to report their share of the investee's net income. If the investee has investor must report those losses as well. Well, what happens if the losses are either bring the investor's investment in investee potentially below zero, or maybe that and a combination of that as well as value losses? What do you do then? Well, if it's a permanent reduction in fair value, you've got to report it as a loss. And so the investor, if it's a permanent decline, must recognize an impairment loss and reduce the asset to fair value. But this loss must be permanent before that type of recognition is considered. If there's a temporary drop in value, you simply ignore that. You do nothing. Well, what happens again if you go back to what I was saying before? You have reported losses and maybe a combination of that and permanent drops in value. What happens when you get to zero? Well, when you get to zero, you have to stop it anymore once you get to zero. Well, what happens if the company continues to have losses and or permanent drops in fair value? To wait until there is enough gains to recoup all the losses, including those that weren't written before you can start building back up. In other words, you can't have a negative balance. Okay? You have a negative balance in your equity account or your investment account. So you've got to have profits that far exceed recognized loss on to zero with your adjustments. That could take a while. All right, if you sell a part of an investment, the equity method continues to be applied up to the date of the transaction. So you've got to make adjustments all the way up to the date of the transaction. And then the investment account balance is reduced by the percentage of the shares sold at the transaction date. Well, here's an important point. If you go from that you had the ability to significantly influence the investee company, but now you've sold enough stock to where you don't have, you don't have operations. So let's say you go from 40% down to 10%. Do you have to make a retroactive adjustment as to equity based? And the answer is no, there's no retroactive adjustment. You just, as of the date that you no longer significant from that date. And so if you look at the bottom of page 17 and top of page 18, they have an example here. What they have to do is they have to deal with any adjustments made up to the date of the sale. And so in this case, they have to adjust for any net income of the investee through the date of the sale and any dividends. So we've got an increase in our investment of $28,000, and you got dividends of $12,000 that the investor has to deal with in their books. And then the second set of entries deals with the actual sale. Here they're selling 1/4 of their investment in this investee company, and the balance as of the date of the sale in the investor's investment is $336,000, and so they're selling 1/4 of that for $110,000. So 1/4 of $336,000 is $84,000. So they record the cash receipt from the sale of $110,000. They back out 1/4 of their investment, the balance in the investment account. So 84 is 1/4 of 336. And of course, they have on the sale of this investment. Of course, you could have a loss, and obviously that would be a situation. Let's say they sold it for $80,000, 1/4 of the investment for $80,000. So they would record cash of $80,000, and of course they would have a reduction in the investment of $84,000. So you would have an additional debit, which would recognize the loss on the sale of investment. All right, one more thing I want to look at is the deferral of unrealized profits in inventory. Many times these investments for strategic reasons other than just making money. In other words, you want to have you want to have an ownership interest in a company so you can have a closer or stuff they use to produce their items if they're a producer, or vice versa. You may have a situation buy stuff from the investee that you place into your inventory. So when you have that type of situation, you have two types of sales. One is downstream. That's where the investor is selling inventory to the investee. That's where the investee is selling inventory to the investor. If you have that sort of situation, not all of the inventory that's sold to either the investor or the investee is passed on process by the investor or the investee. So the inventory, there's unused inventory sitting there, and so you have to deal with income recognition on the sale of that inventory, because the investor still has an interest in the profit margin, the gross profits of those inventory transfers. As it says, because of the relationship between the investor and the investee, the seller of the goods is said to retain a partial stake in the inventory for as long as the buyer holds it. So notice that this is reporting that the investor has to do on their books, regardless of whether they're the one selling the inventory to the investee or the investee is selling the inventory to the investor. And so they give you, so here's your example where investor selling to the investee, that's downstream, and investee selling to the investor is upstream. And so the earning process is not considered complete at the time of the original sale when you have either an upstream or a downstream type of situation. The reporting of the profit is delayed until any portion of that inventory that sits there at the end of the year is consumed within operations or resold to an unrelated party. Again, this is required of the investor, and it pertains to both upstream and downstream purchases. At the disposition of the inventory, the original sale is culminated and the gross profit is recognized. And so they have some examples in the book. They have one using the downstream sales. And so I don't think they have an example here. No, they sure don't. So we'll stop right here. Anyway, on page 19, they have an example of a downstream purchase. And so, let's see, in this situation, Major sells inventory to Miner at a price of $50,000. Figure includes a gross profit of 30% or $15,000. By the end of 2015, Miner has sold 40,000 of the 50,000, which means they still have 10,000 of that inventory for sale in the subsequent year. Major owns 40% of Miner, and so what Major has to do is make an adjustment. And so there near the bottom, you have the remaining ending inventory of 10,000, your gross profit percentage. So gross profit and ending inventory of the investee is 3,000. And of course, Major has a 40% interest. So there's an unrealized intra-entity gross profit of $1,200 in the investee. And so what the investor has to do is make the following adjustment. They debit their equity in the investee company, and they're reducing by crediting $1,200 investment in Miner company. And then let's say the inventory is sold in that subsequent year. At the top of page 20, there's your entry that's made once that inventory is sold. Then they have an example for upstream sales. So the investee is selling to the investor. Same sort of deal. And so it says that the equity method reports upstream sales of inventory in the same manner as downstream sales. Hence, unrealized profits remaining in ending inventory are deferred until the items are used or sold to unrelated parties. And so here, Major company again owns 40% of Miner. Miner sells merchandise costing $40,000 to Major for $60,000. So there's a built-in profit of 1/3, 33 1/3%. At the end of the fiscal period, Major still retains 15,000 of those goods. And so it's the same sort of transaction where, well, it says Miner reports net income of 120,000. So, of course, Major is going to record 40% of that 120,000. So there's your entry for that. Investment in Miner company is your debit for 48, And then equity and investee income is 48 as well. That's your credit. And then down here below, at the bottom of page 20, they do the calculation of remaining inventory of 15, gross profit percentage. So you multiply 15 times the 33 1/3 to come up with gross profit and ending inventory of 5,000. And then you multiply that times the investor ownership interest percentage of 40%. So unrealized entity gross profit here is 2,000. So again, they just flip this. Could they have done all that in one entry along with the entry right above it and just made an investment in minor company for 46,000 debit and equity and investment income of 46,000 credit? Sure, I guess as long as they record everything they're doing, you could certainly combine that, those two entries. All right, they go on to talk about the reporting effects of the equity method and criticisms, but for the most part, we're done here.